Okay, in this video we're going to talk about the new micro crude oil futures that have listed today. In fact, it's not even daytime in the US as I'm filming this. This is the pre-market, well, Globex electronic market anyway, and we're going to look at the market. We're going to put on a couple of trades. We're going to look at the spread market and some tips for trading them and some ideas for short-term and long-term stuff as well. So it should be interesting, so stick around. All right, first up, if you haven't subscribed, please do click the little bell thing and all of that. This is what we have to do these days, but anyway. All right, let's get on with it. Contract specifications for the new micro crude oil market. If you've traded crude oil markets before, then this will be pretty straightforward for you. If you haven't traded futures, then it's really designed as an entry-level futures market. The micro idea, the micro contracts, have been around since 2009, where they were first introduced for foreign exchange contracts. About 2 years ago now, they were introduced for the S&P 500, so you're probably familiar with the E-mini. There's also the micro S&P, which is a smaller contract again. And now they've just introduced crude oil, and next month they're bringing out Treasury futures. We'll do more on Treasury because I think that'll be really interesting. But today they've brought out micro crude oil futures. Let's talk about what they are. There's no difference between a micro futures contract and a futures contract. It's still a futures contract. It's just the contract size. So for a crude oil futures contract, let's call it regular, big, daddy, I don't know, whatever we're going to call it. We have to come up with a name for it. But the regular contract, and the one you may have traded before, is 1,000 barrels, which means every cent that moves, it's a $10 move. Every dollar it moves, it's $1,000. So it's a big contract, particularly given the volatility of crude oil, which we'll look at in a second. But so the reason they've come up with these things called micros, they're essentially 1/10 the size of a regular contract. The reason they've come up is to allow smaller traders or new traders to get involved in the market without risking too much. So it's a 100-barrel contract. Tick size is still 1 cent. It's exactly the same as the big contract, the regular contract, and the margin is 1/10. So currently the margin is 5,300 and change, and the new margin for the margin for the micro is going to be $530. Now, with some brokers out there offer day trade margins, so they'll be even less. Which is, whatever it is, $100 or whatever they do for intraday margins. But $530 isn't much anyway, even if full margining. The codes, if you're familiar with CQG or most other platforms, the codes for the crude oil will be CL. Put an M in the front of it for micro crude oil. Put an E at the end if you're trading CQG, which is what I'm doing, and I'll show you that in a second. Now, there's also a spread market, so which is very exciting stuff. I didn't even expect that to be around the first day, but it is, and we're going to look at that too in a second. The spread market for CQG, anyway, is you add the S at the end. So a spread for in the regular crude is CLES plus your month and plus your year. And then the micro one is you just add an M at the front. All right, boring crap out of the way. Let's get rid of that one. A few tips on trading, and we might even come back to this, but number one tip is one that came from one of our subscribers at Masterclass, Tim, who said when he's trading the E-mini, or the micro E-mini, he looks at the E-mini for technicals and also patterns in the depth of market, which is a fantastic idea. And a prudent idea, I think, for almost all of the micros. That's because the bigger contracts will tend to trade more, and so those patterns that might play out, those highs and lows or certain values or whatever, they'll happen in the big contract more frequently, and again, we'll see this in a second. They'll happen more frequently in the big contract than they do in the little one. So big contract for your analysis, little contract for your execution, or micro contract for your execution, makes a heck of a lot of sense. I mean, you'll still be looking at both anyway, but I strongly suggest with any of these markets, whether it be micro crude, micro currencies, micro S&P, micro Russell, and I'm guessing it's going to be the same for the treasuries next month, the micro treasuries coming out, that looking at the micros in isolation is a bad idea for your analytics, for your indicators, for whatever it is. for your candlesticks, for your levels, all of that stuff. You get the point. Look, this I've got number 2 there is work limit orders. That's kind of that's good advice for pretty much any market. I don't think it's not going to cost you too much to be hitting market, but the reason I put it there is because as this market is new and developing, getting filled on, especially if you're scalping, getting filled on orders is a bit like fishing. So you just need to kind of see what's there. So it's kind of a good idea to place limit orders instead of just hitting market. You're not going to pay, if you pay the spread, you're going to pay $1 or $2, as you'll see in a second. The spread is $1 at the moment, so you're not losing a heck of a lot of money, but I think it's worth doing anyway. So, and it helps you learn about how this market's kind of developing. It's going to change too. As I said, this is being filmed before the first daytime session of the micros. This is the evening session that's already started, but you'll see there's enough volume here already to kind of justify or make it a reasonable trading market. So, but that's going to change over time too. So what develops, how that kind of unfolds, what the market will look like in 3 months will probably be different from where it is now. Okay, that same goes for deferred contracts too. What I mean by deferred contracts is it's now July. The first trading month for this crude oil contract is August. The contract will list 12 consecutive months. So it's not one contract that's trading today, it's 12 new contracts that's trading today. So August, September, October, November, all the way out to July next year. When August expires, then August next year will be made available. For us spread traders, it's worth watching those markets and see how, see what the liquidity is going to be like for a 6 month out or a 9 month out, that type of thing. Okay, we'll talk about some more. I'll show you the spread market in a minute. It's really interesting. Next up, last point, make sure your broker has reduced commissions for micros. Otherwise, it's you're paying too much to trade them. Most brokers do now, but just double check what they've got for these new contracts. And also, if we're looking at spreads as well, make sure your broker spread margins as well. Every broker should, and anyone that doesn't is an idiot. And change brokers if they don't, but make sure they spread margin. What that means is that if you are spread trading, they give you a reduced margin because of the reduced inherent risk of a spread. And that risk is measured at the exchange level. And those margins are dictated and so on. And some brokers don't use those spread margins, but they should. Anyway. Let's get rid of that one. Let's look at this. All right, so just how we're going to use them, and this is specifically for my students there at masterclasstrader.com. Those of you that have done the DOM bootcamp, I think these new contracts are going to be great for our scalping drills, our market making drills. We use a simulator, or it's recommended you start on a simulator when you're looking at this type of trading, but the simulator only works so well because you don't have skin in the game when you're trading the simulator. With these micro contracts, it's very easy to take that next step from when you're learning, when you've practiced a bit on the simulator, and then when you go, it's not the deep end you're jumping into anymore with these micro contracts. So you can trade with a very small, say, daily stop loss and not really risk a heck of a lot. So if you're trading the big contract, let me have a look. The big contract at the moment, September contract, the average true range at the moment is $1.86, or that's 18 on average. The September contract's got $1,800 and $1,860 range per day. Now that's a big contract. If you stuff up what you're doing, you can lose a lot of money in a day, particularly when you're starting on a small bank. With the micros, well, it's 1/10 of that, so $186. So that's the average range for that market right now, anyway. So it's a really good way to take what we learn in the DOM bootcamp to market and practice and do things like stacking the book and averaging in and averaging out and that type of stuff. So I think it's a great market for that, as are the micro S&P and micro Russell. And I'm really looking forward to the treasuries as well, but that'll be another video, the treasuries. For our longer term spread traders, those who've done the spread trading masterclass. I think it's going to be great also for our seasonal spreads. And because there is a spread market in it, again, it's a matter of when you're starting out, you don't want to take a heck of a lot of risk. And as you may well know, one of the advantages of spread trading is that potentially, or most often, the reduced risk of spreads. Well, this reduces it even more. So it's a great way to get into longer term spread trading, stuff that won't keep you up at night if you're holding trades and so on. So with that in mind, let's get rid of that one and have a look at the market itself. Here we go. All right, so this is one of my trading screens here. I'll just talk you through it before we look at the market specifically. Down the left-hand side, I've got the August crude oil, the big contract. Down the right-hand side, excuse me. Down the right-hand side, I've got September, the big contract again. In the middle, by the way, left-hand, I should go through. A 3-minute chart here, August, 3-minute chart, September. Can you see that? Yep. What's that? 10 minutes and 10 minutes, 2 hours. 2 hours, all symmetrical and nice, and daily charts down here. It's not particularly important for what we're looking at, but what's important is the stuff in the middle, and this is the depth of market display for, I've got here on the left, the big contract, August, and the big the micro contract, August. So if you're looking at this on the phone, you're probably not going to see these numbers so well, but I'll talk you through it. If you're looking at it on the screen, just enlarge it to the full screen. If you have a small screen, buy a bigger screen. Down the left-hand side here, this one here, can you see that okay? That is the full-size contract. You can see the scale over here against the micro is exactly the same. It still trades in dollars and cents, and tick size is 0.01, 1 cent. You can see the depth of the depth, however, is quite different. That is the volume that's on the bid, volume that's on the offer, and the volume that's been through the market today so far. It's 6 p.m. Australian time now, so the market's been trading, what, 8 hours, 9 hours or something. You can see here down the left and right hand side of the scale, this one here I'm moving, you've got 30 on the bid, 35, 20, 17. On the offer, you've got 30, 20, 30, 40, that kind of amount on each price. Over here on the micro, you do not have that. You've got 6, 12, 1, 2, 1. What I suspect here is that most, if not all of these are market-making type algorithms. You'll see that they move around in lots of 10. So here you've probably, there we go, the market's moving quickly. Hopefully you can just be quiet while I'm saying this. But you'll see that there'll be market-making type algorithms and spread trading market-making algorithms in there that are either trading one lot or 10. The reason they're trading 10 is because 10 contracts in the micro equals 1 contract in the regular size one. So I suppose the idea with this, here we've got, let's say someone's buying 10 at 94 cents. If they can sell it for say 95, which is where the bid is right now on the big contract, then they make $10. They buy 10 micros, sell one, sell one full-size contract and make $10. I wouldn't do it either, but anyway, that's what these ones do. So you can see that type of activity going on, lots of 10 lots on there, which is the reason I point that out. It's not important to us. I'm not saying we trade in 10 lots. We don't need to trade in 10 lots, but it's great if you are just starting out because you know there's going to be liquidity there. I've been watching this for a few hours now. There is a 2 to 3 cent bid-ask spread on that, where actually it's 1 to 3 cent bid-ask spread. So it's always going to be relatively tight because of that. Because of these algos in there creating essentially the liquidity for us. It doesn't look that great by itself, but it's always going to be tethered to the underlying market or the regular market. So the one's not going to get away on the other. Right? You'll only notice this on the depth of market because it doesn't trade at the moment. This micro is not trading as often as the regular size one, but that's okay for our purposes because the bid and ask will always move with it. if that makes sense. Okay. So, like I said, let's place a couple of orders. I've got a 2 lot on my default here. Market's been running down. All right, let's just bet on a little bit of a reversal. Let's see if we get filled. I put a 2 lot in there at 94. TikTok doesn't get filled straight away. Market's basically stopped and wondering what I'm doing maybe. All right, come on, mid 94. All right, we're filled there. It's gone a few cents against us. That's okay. I'm not losing a lot of money. It's $1 a tick, right? Who cares? And I'm going to put a stop in there at where are we? 73.94, 93. Okay. And I put a stop in there as well. So I put a little trailing stop in there, so I'll kind of go and cook dinner in a minute and forget about it. So that's essentially relatively easy to get filled. Like I said before, with some tips for trading, instead of going headfirst in and trading at market, trade via the depth of market, and that way you can set limit orders and get set, not necessarily at the worst price. Okay. And so if you're not familiar with this depth of market trading, take a look at the course. I'll put the link at the end for our DOM bootcamp, as we call it. But anyway, besides that, let's look at spreads. For those of you that have traded spreads, and those of you who know me know that that's pretty much all I do, except for what I just did then. Let's take a look at the spread market. I'm actually surprised to see the spread market's already there and already has a lot of depth in it. Again, it looks like all these algos are trading in lots of 10. Now, what we mean by spread market, if you're not familiar with it, an exchange like the CME in its active contracts will offer what they call a spread market. So you'll be able to find charts and your depth of market here for the spread, for various spreads. In this instance, for example, I'm looking at the micro August versus September spread, micro September versus October spread, micro, what's that one? September versus December spread. Really interesting to see that these spread markets are already pretty tight. So there's a 1 cent spread on that first month, as in 1 cent bid ask difference. Same for the second month spread, and there's a 3 cent spread there for that 3 month spread, which is kind of normal anyway. You can see a lot of the depth there is in 10 lots. Obviously trading against the big contract, and that's cool too. Again, this gives us the liquidity we need for just trading smaller in these kind of things. So like I said earlier, we have an advanced spread course at Masterclass Trader. Those of you that have done that will know that there are trades that come up in our database that look at crude oil. Well, here's how to do it by dipping your tiny little toe in the water and going in the shallow end with these kind of spreads. So I think they're a fantastic market for that. Absolutely fantastic market. Let's go back to my little tips for that. Where are we? So as I said, I thought we'd come back here. Watch the full contract because I think that's a heck of a lot better than watching the micros, because the full contract's going to trade a whole lot more. But your bid ask is always going to be there for the micro contracts. Right? Again, work limit orders like we just did, and watch these deferred contracts. But it looks like already, as I said, this is being filmed before the day session, the first day session for the micro contracts, and the liquidity's there for the spread market. It doesn't look amazing, doesn't look fantastic, it doesn't look like the spread market for interest rates or the full size contract or natural gas or anything else like that. But there's enough there to get filled and not get too screwed on a bid-ask spread. So I think it's off to a really good start. I think it's a great contract, and again, for your if you're relatively new to futures, I think the CME, hit the nail right on the head with this one, because I think it's going to work out really well. Really looking forward to Treasuries coming out next month. We're going to do a heck of a lot more on those as well. Because I think they'll be a whole lot more interesting. And so that's about it. Yeah, but before you go, couple of things you can do. Subscribe and like these videos because that's what we do. My site, tradarian.com, please go there, sign up for the free email. I won't spam you. I might send something once a month or something. I don't know if I get around to it. I haven't sent one for a while. But also my masterclass trader.com site. Take a look there. We have a course there on trading depth of market like we did today. And also trading longer term spreads like we looked at today. So if that's your interest, take a look and see how you go. Until then, till we speak, good trading.